Good day to Dr. Bright that will be evaluating our presentation for Principle of Finance. We'll be presenting a financial comparison between 7-Eleven Malaysia Holdings Berhad and Mr. D.I.Y Group Malaysia Berhad based on their financial performance over the period of financial year 2022 to financial year 2024. I am Faizal and this is my teammate Howard. We'll be taking you through the purpose of our analysis, the methodology, key financial ratios, findings, recommendations, and conclusion. Let's begin. The purpose of the analysis is to compare the financial performance of 7-Eleven Malaysia and Mr. D.I.Y using key financial ratios. We focus on how each company has performed over time and how their business strategies impact financial outcomes. This analysis covers financial data from financial year 2022 to financial year 2024 and includes an evaluation of liquidity, efficiency, debt profitability, and market valuation ratios to assess financial performance and risk. We selected 7-Eleven Malaysia and Mr. D.I.Y Group because both companies are publicly listed on Bursa Malaysia's main market and operate in the Malaysian retail sector. Although they operate in the same broader industry, their business focus differs. 7-Eleven Malaysia is a convenience retailer focused on food, drinks and daily items, whereas Mr. D.I.Y is a value and home improvement retailer. Comparing these two models help illustrate how different retail strategies influence financial results. Next, for our financial data, we use audited annual reports from financial year 2022 to financial year 2024, available on each company investors relation page, along with official Bursa Malaysia Finance, Yahoo Finance and KLSE screeners for market data. We extracted key financial figures such as assets, liabilities, revenue, profits, and then computed financial ratios including liquidity, leverage, profitability, and market evaluation ratios. We then compared the result over 3 years to identify trends and performance differences. Next, liquidity ratios measures a company's ability to meet short-term obligation. For Mr. D.I.Y, the current ratio improved from 1.91 in 2022 to 2.38 in 2024, indicating stronger short-term liquidity. Its quick ratio also strengthens from 0.38 to 0.68 over the same period. In contrast, 7-Eleven Malaysia's current ratio remained volatile, from 0.96 in 2022 to 0.86 in 2024. And its quick ratio also weakened from 0.55 to 0.46. This suggests tighter working capital conditions with Mr. D.I.Y, demonstrating relatively stronger liquidity. Now let's look at activity and efficiency ratios. Inventory turnover indicates how quickly inventory is sold and replaced. 7-Eleven Malaysia has higher inventory turnover, averaging around 4.17 times in 2022, 4.93 times in 2023, and 4.78 times in 2024, reflecting faster stock movement. By comparison, Mr. D.I.Y inventory turnover was lower, around 2.53 times in 2022, 2.19 times in 2023, and 2.32 times in 2024, which is consistent with its broader range of stock keeping units. In terms of assets turnover, Mr. D.I.Y generates more revenue per unit of total assets, whereas 7-Eleven has lower asset turnover across the same period. That will be all from me, and the next part I will pass to Howard. Thank you, sir.
Solvency ratio show long-term financial risk for Mr. D.I.Y. The debt to equity ratio was around 1.04 in 2022 and 0.96 in both 2023 and 2024, indicating moderate leverage. Its interest coverage ratio was strong, above 11 times each year, demonstrating a comfortable ability to cover interest expenses. In contrast, 7-Eleven Malaysia debt to equity ratio was significantly higher at 11.43 in 2022, 10.63 in 2023, and 6.17 in 2024. Its interest coverage was lower, ranging between 2.16 and 3.01 times, which signal higher financial risk compared to Mr. D.I.Y. Profitability ratio show how well a company generate profit. Mr. D.I.Y. had strong and stable profitability with gross margin of approximately 41.3% to 45.8%, operating margin around 70.7% to 18.9%, and net margin of about 11.9% to 12.9%. Meanwhile, 7-Eleven Malaysia had lower gross margin around 30.9% to 32.2%, and thinner operating and net margin. It even recorded a net loss in 2023. This indicates that Mr. D.I.Y. has consistently higher profitability over the 3 years. Market valuation ratio reflect investor expectation for Mr. D.I.Y. The P/E ratio was relatively stable, 40 times in 2022, for 24.6 times in 2023, and 30.8 times in 2024, and its P/B ratio ranged from 7.8 times to 13.2 times over the 3 years. 7-Eleven Malaysia P/E ratio was more volatile, 30.76 times in 2022, 8.27 times in 2023, and 52.53 times in 2024, largely due to fluctuation in earnings. This volatility suggests less stable investor confidence compared to Mr. D.I.Y. To summarize our key findings, Mr. D.I.Y. shows strong liquidity, higher profitability, moderate leverage, and relatively stable market performance over the 3 years. By comparison, 7-Eleven Malaysia has faster inventory turnover but weaker liquidity, thinner and more volatile profitability, and significantly higher financial leverage. These different reflect the impact of their respective business model on financial performance. Based on our analysis, we recommend a buy rating for Mr. D.I.Y. Group due to its strong fundamentals, consistent profitability, improving liquidity, and manageable leverage. For 7-Eleven Malaysia, we recommend a hold although it operates in a defensive retail segment. Its tighter liquidity, earning volatility, and higher leverage increase its financial risk. A buy recommendation would require clearer improvement in net profitability and financial stability. In conclusion, Mr. D.I.Y. demonstrates stronger overall financial performance than 7-Eleven Malaysia across most of the key financial indicators during the analysis period. 7-Eleven continues to face challenges in working capital and profitability, and our finance ratio analysis clearly show how different in business strategy lead to different financial outcome. Thank you for your attention, and we are happy to answer any question.